This is the Cash Value Solutions Podcast, where your hosts, Jason Pohlmeyer and Kyle Mann, shed light on little-known money truths to help you take control of your financial future and become your own banker. Subscribe, rate, and review the show, and check us out at cashvaluesolutions.com.
Hey everyone, welcome back to the Cash Value Solutions Podcast this week. What do we have on tap, Kyle?
Well, we have a pretty commonly asked question. How long should I pay into a policy? Well, it depends.
Our favorite answer, it depends.
Yep.
Obviously, it's different for everybody. Everybody's at a different stage in life, age-wise.
Goals.
Some people have the direct intention of being done working at a certain age. Maybe income is going to stop at that point in time.
Sure.
Or at least income not coming from like a qualified plan or something, or a brokerage account, if you're only in your 50s, I guess. So I guess a lot of things have to be covered. But a really simple rule of thumb is, well, as long as you're bringing in income, you're going to need a place to put it.
Yep.
An IBC plan is a very easy way to store capital, so why not put it here?
Yeah.
And it'll give you a lot of benefit.
Usually, like the most general and common answer we would give to that is as long as you can. The policies get more efficient over time. So, I mean, you really do want to pay in them as long as you possibly can. And it's not like, we set up a policy for you that is payable until 100, 121, whatever. It's not like you have to pay it until those years. Like when you've had a policy for that long, it is not that big of a deal to either have the policy, pay for itself, pay the minimum, or reduce, pay it up, whatever. We have endless options.
Yeah, and things that don't have to be decided from the onset of taking out the policy either, which is tremendously a huge advantage.
Well, that just, we focus on flexibility. That provides a bunch of flexibility, and we don't know what the future holds. So I think, I don't think it makes sense. I know a lot of people will push 10 pays or 20 pays or whatever, but if you're going to keep making money every year, I mean, why would you ever want to stop putting it in an IBC policy when it's only getting more efficient every single year?
Absolutely. Excuse me. And this is something that I like to go over with people. Sometimes I guess it's easier to see in different policy design where you're actually looking at some numbers, but it is good to try and hone in on whatever that number is for years that you want to pay into a policy, because things can be done to improve performance of policies that we're going to pay into for a short period of time. We may be able to use different PUA riders, structure it slightly differently, maybe a smaller base, a bigger PUA, and instances of short pays. And it's not that you can't design a policy to pay into it for a long period of time, say, like 40 years, which is what my first policy was designed for. It's just the fact that if you do that, you typically are going to give something up in the form of cash accumulation if you decide to only pay into that for 7 years.
Sure.
That doesn't mean that you're giving something up in the sense that into the future, like you're giving up the opportunity to pay in all those premiums. What I mean is you've given up some policy optimization in the beginning that caused cash to accrue at a slower pace. And because you aren't going to fund it as long as you thought you were, it's going to continue just by the lack of the fact that it didn't have as much cash in it in the beginning to still be slower.
Sure.
Obviously, those things are very hard to know, but it's something that we like to have a good conversation with people about, because we always want to give you the best possible plan that we can, and we just don't know without, working through what your situation is, what that looks like.
And that's where, a lot of people like to fight over the base to PUA splits and what's the correct and what's not correct. And if you have lower base premiums, I mean, generally you can't fund them as long. It's not that maybe it's a bad thing to have a lower base premium. It's just, is that what you need? Do you need that upfront heavy cash value right away, or do you want to fund longer?
And, something else too, maybe, this can be common for people. Well, I want to fund a policy, for the next, say we're talking to a 30 to 40-year-old. Well, I want to pay X amount of dollars in this policy for 30 years. Let's say $20,000. And at the end of that, I doubt that I'm going to want to pay in that $20,000, but I still may want to pay into this thing. Well, maybe we can design a policy to hold that $20,000 and say $4,000 to $5,000 maybe. You can continue to pay after those 30 years or something like that.
Sure.
And so that still is getting you what you want, but yet we haven't overbuilt the policy to the point where it's hurting you. And you're still, this is something that I'd like to go into for people that are undecided is, okay, if you think that you want to pay into the policy for 20 years, okay, that's great. We can design it for that. If you think, well, 20 years, but I mean, I don't know, maybe I want to do 30 or even longer than that. Okay, we can do that, but oftentimes we're going to give up a little bit of flexibility and some cash accumulation by building in that room for later on. It might just be a situation where, you aren't sure. You just take a look at each different option, and maybe it's a small enough amount that you're like, it's not even worth it. I'd rather have the option to pay, longer into the future than this little bit of cash accumulation that I'm missing out on.
Sure. And like as time goes on, you're more than likely going to be making more money. Like even in your 60s and 70s, you probably have accumulated either, businesses, properties, whatever it is that you're going to be, having income from for the rest of your life. So where are you going to put that money?
Mm-hmm. And, that this is a place where you can do that. And I think what you were also getting to is, likely this isn't going to be your first policy. So we're probably going to be starting other policies. We can design those to be paid into for, an age that is past what your first one is.
Sure.
So you still have the ability to put a significant amount of premium into your policies.
Yeah. I mean, most policies aren't designed the exact same, for each person. It depends on age and goals and what we want to do, what they want to do. So.
It isn't like we're just going to design a policy to be paid in until age 65 and then, no more.
Or even, maximum cash value in year one, from the insurance company. Maybe what they want doesn't fit that.
Yeah. For other people, they may want to put a lump sum into a policy and then, pay the minimum and have that as their strategy. Probably not where I would get started at. But for some people, they like to see that sort of option and what that looks like. I can tell you that it's probably going to be an inefficient policy.
Or lump sum mix too.
Yes, we've done that for especially for older people.
Works great. One-time payment, don't think about it again, and it's there if you need it. You might have to pay some taxes on the gains. Who cares? Because you have gains, that's pretty awesome.
Yeah.
And death benefit, adding velocity to the dollars.
But I would say the big thing with that mech is the ultimate goal was death benefit, liquidity, passing on as much money as we could to the next generation.
Yep.
It wasn't about,
banking
and needing this money in the future. It was money that they don't believe they're going to need. But
it's there if they do.
Yeah, but it is there if they need to. And they don't have the 10% penalty because past age 59 and a half.
They don't have the risk of losing it either.
That is huge. Locking in gains.
It's there and it's going to grow above what you've put in.
Yep. So those are, obviously that is a very short funding period. You can typically put some extra money into mechs though, past that first year. Just know that it is a mech, and you're going to continue adding to a policy that will be taxed on a first in, first out basis, or excuse me, a last in, first out basis. But if the situation is right, that's fine. There's nothing wrong with that.
Yeah, absolutely.
So, anything else you'd like to add to this, Kyle?
No, I think we got this one covered.
Okay. It's really, it's an individual situation, and it's something that, I mean, we cannot tell you, this is what you need to look for.
Without seeing your situation and knowing what you want.
Yeah, without seeing your situation. I will say, one last thing I forgot to mention is it can be common to do shorter pay policies if you have like a one-time, say, an inheritance or sale of an investment property or land or something that you don't foresee getting back into.
Sure.
And putting that into a policy in a short number of years. Maybe you pay a little bit after that, maybe not. But
You never know, which is why we keep, harping on flexibility and why that's so important.
Yeah, hugely important because the future is unknown.
Yep.
So, all right, that's all I got, Kyle.
All right, we'll see you guys next week.
This was the Cash Value Solutions Podcast. Remember to subscribe, rate, and review the show. Check us out at cashvaluesolutions.com. And don't forget to tune in next week.